So in the investing journey, one of the important things is to try to figure out what kind of an investor you are. And I had, when I was younger, I was always trying to find which stock I thought would appreciate and do well over many years. And I had read Peter Lynch's books, One Up on Wall Street and Beating the Street, and he was always talking about finding the next growth stock, and I really struggled to be able to find good growth stocks. I was always on the watch for one, but I didn't have the knack for it. Then I basically became what I would call a dividend investor, and I've had a lot more success looking for good dividend paying stocks than I have what is the next growth stock. And I think part of the reason why I find that's my niche is that it makes your calculations easier. For finding the next growth stock, you have to figure out which thing is going to grow and not go out of business. With a dividend stock, you basically have to figure out, does the company have sound financials? Do I feel like the dividend is safe? And then I also try to diversify over multiple dividend paying stocks, but it makes it easier to plan. If you know a company is going to pay out X amount as a dividend and you hope the shares will also appreciate a little bit to stay in front of inflation, you kind of say, well, if I know the dividend is this, I can just plan on that and work it into my overall financial calculations. And so today I wanted to talk about one of the dividend stocks that I own, which is called Enbridge, and the ticker is ENB. And I find this a really interesting stock. It has a fairly high dividend. As of today, it was just right below 6%. I think it was 5.9%. But the price kind of fluctuates a little bit, and I'll just call it 6%. Which, if you compare that to the S&P 500, it's much higher. S&P is like 1.3% or something. Enbridge is at 6%. So if you're just doing simple calculations, it makes it a lot easier to try to say, all right, how much do I have to save in order to have enough income to live on? And so the quick simple math is, if you have a 6% dividend and you have $1 million saved, that gives you $60,000 a year in income from a stock like Enbridge. Or if you had $500,000, it would give you $30,000 a year. And you can use those, like if you're retired and you get Social Security as well, maybe you put part of your funding in a company like Enbridge, and the idea is that you should be able to just trust in the income that comes from the stock, and just use it over the years. So important things to kind of check on is there's dividend safety factors. You can look up that score from various websites. Enbridge has paid and increased their dividend for 30 years straight. So companies really try to, once they get a streak like that going, to not break it. But you got to make sure they don't pay out more than they actually take in. So there's some sites that say Enbridge's score looks pretty good. They're not paying out too much. They're kind of growing and thus potentially a safe dividend score. So, if you put $100,000 into Enbridge, it would pay you $6,000 a year in dividend income. And so that makes it easy to kind of calculate, based on where you're at. Do you have $10,000 to invest, or $1,000, or $50,000, $100,000? If you can just count on a 6% income every year, that makes it easier to calculate, well, what happens in a year's time, or 2 years' time, or 10 years' time, or 20 years' time, and you can kind of just base, your increase on that dividend. Some of the things that I think Enbridge has going for it. So I live in Utah, and Enbridge bought out the natural gas pipelines from another company called Dominion here, and they bought it for Utah and Idaho, I think part of Colorado, and so it was a large purchase. I think it was something like $13 billion worth of pipelines, and so now they have those assets, they own them, and they're going to be able to use those assets for years to come to then make money. So it's kind of like a utility stock. Most of the time with utilities, you think of them as electricity producers, but Enbridge moves natural gas around, and so it's really hard to make pipelines. So once you own them, you basically just get to harvest the income from them year after year after year. So that's something I like about Enbridge, is that it's considered to be in the utility class rather than an energy exploration company or something. And they get paid to move energy around the country, and so they're some of the utility rates are kind of regulated by the government, but they get to increase them slowly over time, so that should keep up with inflation. And then also more and more natural gas is the energy of choice for AI data centers. I think I saw an article just the other day about a new data center in Texas that had bought something like 17 natural gas turbines from GE Vernova. And it wasn't clear if all 17 were going to be at that site or not, but these data centers need a lot of electricity, and right now really the only fuel that can supply those is natural gas. So somebody has to move the gas to those data centers, otherwise the AI won't work. So that's something interesting about Enbridge particularly, is it's the largest natural gas pipeline system in the country. I think it has 20% of all fuel or natural gas that's moved around. So it's a big monster of a company, which also gives you some safety. So again, about a 6% dividend yield with this one. Do your own research to check up on the safety score for this particular utility company. But if you're on your path to financial independence, you can pretty easily calculate, well, how much of this stock would I need in order to generate the income that I need? And if you need $60,000 a year of passive income, well, then you need to save $1 million in the stock. The way that I do it is I kind of invest across multiple utility type companies. I bought a piece of every pipeline company I could find, and Enbridge was one of those companies. I probably have at least $50,000 in Enbridge, over a few different accounts. I might have more, I'm not really sure. I guess one thing I'd mention is right now they're almost at an all-time high, and that can be good for a stock. If it's breaking out to a new all-time high, chances are it will continue. I think the price recently almost got to the point where it surpassed the previous high, but then it kind of pulled back a little bit. So you could consider it being in a base. It's at a cup with handle base, and we're kind of in the handle right now. It's been 4 or 5 or 6 weeks now since we last attempted a high. So you can look at it either one or two ways. Either it's highly priced and it's going to fall back to kind of more of the average, or because of all the AI stuff that's going on, it might be a potential breakout that might take Enbridge higher considerably over the next while, particularly if inflation's a thing. I kind of wonder if all the spending of the government and everything is just inflating our monetary supply, and really every stock that's out there and every asset is going to continue to just push higher because inflation is just happening. So if that's the case, then all stocks and Enbridge will just continue to go up over time as the value of our dollar loses more and more money. Another thing that I think is positive for Enbridge is that if the Fed does cut interest rates, I think that has two effects. Number one, it makes it harder for a retiree to get the income they need from money market accounts. So they'll start looking for other assets that generate income. So they may have kept a bunch of money in cash. They're saying, I can't get the income I need from the cash. And so they start to look at dividend payers, and utility companies are one of those traditionally safer types of places that retirees look for income. So if the Fed cuts rates, then more people will be looking for income. That could boost Enbridge's price up, as well as if the Fed cuts rates, then the cost to service debt that Enbridge has will get easier to bear. And so if their debt load isn't as heavy, then that's something else that can also cause the price of Enbridge to go up. So, this isn't financial advice. I'm just kind of giving you some of the things that I think about and I learn If you're looking for potential dividend payer, check out Enbridge stock. Again, that ticker is ENB. It's a Canadian company, so you do get a little bit of a foreign tax charge that you can, if you own it in a retirement account, you basically just lose that. But if you have it in a normal brokerage account, you can harvest that back again on your taxes. So that's something to be aware of. But it's a big company, and they have pipelines all over America and Canada. I think they own a little bit of what's the right word for it? Like solar, wind power, hydrothermal. So they do a little bit of green energy stuff, but primarily they're moving oil and natural gas around the country. So that's a potential idea. Take a look. Makes it easy to calculate. If you know you're going to get 6%, then it makes it easy to figure out, okay, how much do I have to save to be able to live on. And if you want to know how long it takes for you to double your money with a stock like Enbridge, take 6 and divide it into the number 72, and that tells you how many years it'll take with dividends reinvested for you to double. So if they had a 7.2% dividend yield, that would be 10 years time to be able to double your money. So with the 6%, it's not quite that. I didn't do the math. Maybe it's 12 years or 13 years or something. So, but if Enbridge stock also appreciates as well as the dividend, it'll be quicker than that. So potential grower for the dividend, grower for the potential NAV. Your stock price should continue to go up, at least you hope. It is kind of at a high right now, so you know, it could fall back down again, could continue to go up. I don't make a prediction, I don't know. But the dividend is a pretty healthy amount right now. So take a look, maybe it'll be good for you. And cheers, hope you got something from this. Like, subscribe, we'll see you, bye.